The CAPM is a financial model that helps investors figure out what return they should expect from an investment based on its risk. It's based on the idea that investors should be compensated for two things: time value of money, the basic return you'd get for investing without risk; risk, the extra return you should get for taking on more risk. The basic formula for CAPM is expected return equals risk-free rate plus beta multiplied by market return minus risk-free rate. Let's break this down. Risk-free rate. This is the return you'd get from a risk-free investment, like a government bond. Let's say it's 2%. Market return. This is the average return of the whole stock market. Let's say it's 8%. Beta. This measures how much an investment's returns move compared to the market. A beta of 1 means it moves exactly with the market. Higher than 1 means it's more volatile. Lower means less volatile. Market return minus risk-free rate. This is called the market risk premium. In our example, it's 8% minus 2% equals 6%. Now, let's look at some practical examples. Example 1. A safe stock. Let's say you're looking at a utility company stock with a beta of 0.75. Expected return equals 2% plus 0.75 multiplied by 8% minus 2% equals 6.5%. This means you should expect a 6.5% return for this relatively low-risk stock. Example 2. A risky tech stock. Now consider a new tech company stock with a beta of 1.5. Expected return equals 2% plus 1.5 multiplied by 8% minus 2% equals 11%. You should expect a higher return of 11% for this riskier stock. Example 3. The market as a whole. The overall market has a beta of 1 by definition. Expected return equals 2% plus 1 multiplied by 8% minus 2% equals 8%. This matches our earlier assumption about market return. The CAPM helps investors decide if an investment is worth it. If you can get a higher return than the CAPM predicts, it might be a good deal. If the expected return is lower, it might not be worth the risk. Remember, this is a simplified model and real-world investing is much more complex. The CAPM has limitations and doesn't always perfectly predict returns, but it's a useful tool for understanding the relationship between risk and return in investing.